Most of the funds we read about in the financial press are actively managed. Active funds try to beat the market by investing in the right things at the right time. It's an appealing idea, especially when markets are volatile. The problem is that in the long run, the vast majority of active managers don't beat the market at all. S&P Dow Jones Indices has researched active fund performance over many decades.
The history of all financial markets is potted with periods of extreme uncertainty, volatility. In these periods, when prices swing dramatically and differ enormously, there is clearly opportunity for outperformance, opportunity for some to do very well. Unfortunately, there has to be a commensurate opportunity for embarrassment. Remember, we still have the law of averages to deal with, and if anyone is above average, by whatever amount they are above average, in aggregate there need to be enough people below average, otherwise the average is not the average. Statistically, what our data shows in terms of our SPIVA scorecards, our persistence scorecards, our own analysis, is exactly that.
Interestingly, the ongoing research that Dr. Edwards and his colleagues conduct shows that poor performance by active managers is a pervasive problem. It applies to funds investing in every category of equities and indeed in bonds. But do active managers perform better in some countries than in others?
So in the 10 years running to June 2024, 84.7% of US large cap actively managed funds underperformed the S&P 500. 84.7. And the equivalent for the United Kingdom, so the UK large cap equity active space, that statistic over 10 years, how many funds underperformed the appropriate benchmark? 84.0%. Different? Yes. Materially different? No.
It's because so very few active funds beat the market after costs in the long run that passive investing is such a sensible option. Index funds aren't perfect, but they're often unfairly blamed for issues such as market concentration or the dominance of large US tech stocks. Trends driven more by investor sentiment and corporate performance than by the mechanics of indexing.
It's really important to recognize that while different market benchmarks may see different levels of concentration over time, that's not something inherent to the benchmark, it's something inherent to the market. It's really important to emphasize, pick any of the, if you like, the Magnificent Seven, or pick a stock and say that stock is 8% of the S&P 500. What that means is that everyone who is tracking the S&P 500 has 8% in that company. It also means that everyone who is not tracking that index in aggregate has 8% in that company, because the index just reflects what's going on in the market as a whole.
There will always be a demand for active funds. Some investors are bound to want to try to outperform, but the evidence shows that most are likely to be disappointed. Index funds really are the logical choice.